Here is something that simply is not being discussed enough as people begin to consider their finances for the coming year. A significant change to the tax code is now in effect, and a lack of awareness could cost retirees thousands of dollars that should rightfully remain in their pockets. This is not speculation. A new rule from the Internal Revenue Service has just taken effect, creating a substantial tax break specifically for individuals aged 65 and older. This provision allows for an extra deduction of $6,000 for single filers and $12,000 for married couples filing jointly. This is not a complicated loophole or a fleeting gimmick. This is real, legitimate savings that can stay in your bank account instead of being sent to the federal government. However, there is a crucial detail that must be understood. This deduction is not permanent. It is scheduled to remain available for tax years beginning now and running through 2028. That creates a window of exactly 4 years to utilize this benefit before it is currently set to vanish. Naturally, one might wonder if there is a catch. There is an important limitation. The full deduction begins to gradually reduce for single filers with a modified adjusted gross income over $75,000 and for married couples filing jointly with income over $150,000. The powerful aspect of this new rule is how it combines with existing deductions. This new amount stacks on top of the regular standard deduction and the existing additional deduction for those over 65. For a married couple where both spouses are eligible, this could mean shielding close to $47,000 of income from federal taxes. This represents genuine financial relief for those on fixed incomes who are watching the purchasing power of their savings erode due to inflation and ever-rising costs. Listen closely, because this information should influence every decision you make about your retirement income for the next 4 years. This is not a minor accounting adjustment that saves a few dollars. This represents a fundamental shift in how a portion of your retirement income is treated for tax purposes. Without a clear understanding of how it functions, you risk leaving a significant amount of money unclaimed. Let us break this down clearly. First, you must understand that this new senior bonus deduction is entirely separate from the standard deduction you are already familiar with. For many years, taxpayers aged 65 and older have received an extra amount added to their standard deduction. That older increase still exists. What is brand new is this additional $6,000 deduction that appeared as part of recent legislation. What makes this particularly noteworthy is its flexibility. It is available to taxpayers whether they choose to take the standard deduction or whether they itemize their deductions. Please read that again. It does not matter if you are listing every medical expense and charitable contribution or simply taking the standard amount. You can still claim this reduction in your taxable income. This dual availability is quite uncommon. Most tax benefits force you to choose one path or the other, but this one applies regardless. Now consider what this looks like with real numbers to grasp the full scope of the benefit. Imagine you are a single filer aged 65. For the current tax year, your standard deduction is $15,750. That is the baseline. Because of your age, you add the existing additional amount of $2,000. Now, assuming your income is below the $75,000 threshold, you add the new bonus deduction of $6,000. When you add these figures, you find that a total of $23,750 of your income is completely shielded from federal income tax. Pause and consider that. If your income comes from Social Security and modest withdrawals from retirement accounts, nearly $24,000 of that money is tax-free before you owe a single penny. For married couples, the figures are even more substantial. The standard deduction for a joint return is $29,200. Each spouse aged 65 or older adds an extra $1,600 from the existing age-based deduction, which is $3,200 total for a couple. Then you add the new senior bonus of $12,000, or $6,000 per spouse. Suddenly, you are protecting over $46,000 of your combined retirement income from federal taxes. That is not a trivial sum. That is serious money for individuals who need their savings to last for decades. A common mistake is to assume this deduction is applied automatically. That is not how it works. You must actively claim it, and you must do so correctly. The process, fortunately, is not overly complex. The bonus does not require itemizing and can be claimed on your Form 1040 or the Senior-Specific Form 1040 SR. The 1040 SR features larger print and clearer instructions designed for taxpayers over 65. On that form, you will check the box indicating you are 65 or older. That simple action triggers the calculations that ensure you receive the benefit. A critical point often missed in discussions is the temporary nature of this provision. This new deduction is effective only for the years 2025 through 2028. Unless Congress acts to extend it, it will disappear after you file your 2028 tax return. That gives you 4 tax filing seasons to take advantage. For the years 2025, 2026, 2027, and 2028. This finite window should inform your financial planning decisions over this period. Now let us examine the income limits, as this is where the details become tricky for some. The deduction phases out based on your modified adjusted gross income. For single filers, the phase-out begins at $75,000. For married couples filing jointly, it begins at $150,000. What does phase-out mean in practice? It means that for every $1,000 you earn above these thresholds, your deduction is reduced by $60. Doing the math reveals that for a single filer with an income of $175,000 or more, the deduction vanishes completely. For a married couple, it disappears entirely at $250,000. This structure aims to target the benefit toward low and middle-income seniors. However, even if you are within the phase-out range, every dollar of the deduction you can still claim is valuable. It is also vital to clear up a widespread misconception. There is a rumor that this deduction eliminates taxes on Social Security benefits. That is not accurate. The bonus deduction reduces your overall taxable income, which may indirectly lower the portion of your Social Security benefits subject to tax, but it does not change the fundamental rules governing Social Security taxation. Those rules remain unchanged. If your combined income exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, a portion of your benefits will still be taxable. This deduction can help, but it is not a magic solution that removes all tax liability on Social Security. Consider a real-world scenario. Assume you are a single retiree receiving the average Social Security benefit, around $24,000 annually. Under current law, up to 85% of that, or about $20,400, could be taxable. However, with the standard deduction of $15,750, plus the existing $2,000 age-based addition, plus this new $6,000 senior bonus, your total deductions reach $23,750. In this case, your deductions could potentially cover the taxable portion of your Social Security, resulting in little to no federal income tax owed. That is a powerful outcome. For a more complex situation involving additional income from an IRA, part-time work, or investments, the savings remain meaningful. Strategic planning becomes essential. You might consider the timing of your retirement account withdrawals or other income streams during this 4-year window to maximize the benefit. Perhaps accelerating certain income into these years, or deferring other income until later makes strategic sense. Another key point is that this deduction is available whether you are fully retired or still working. As long as you are 65 or older and meet the income requirements, you can claim it. This is especially important for those in a transitional phase, scaling back work, but not fully stopping. Regarding the mechanics of claiming the deduction, the process is straightforward. When you file your taxes for this year, you will use either Form 1040 or 1040 SR. A new schedule, Schedule 1A, is where this senior bonus deduction will be calculated. The form will guide you through determining your modified adjusted gross income, calculating the deduction amount you are eligible for based on your income, and transferring that figure to your main tax form. This deduction is a smart piece of policy because it acknowledges the current economic pressures on seniors. Years of inflation, climbing healthcare costs, and high prescription drug prices strain fixed incomes. An extra $6,000 in deductions translates to real savings. If you are in the 22% tax bracket, That $6,000 deduction saves you about $1,320 in actual taxes. That is money that can pay for medications, cover insurance premiums, handle repairs, or simply provide a little more breathing room. It will not solve every problem, but it offers meaningful relief. This senior bonus is part of a larger package of tax changes, but it stands out as one of the most generous provisions for older Americans. Its flexibility, working with either filing method, makes it widely accessible. The challenge for you is to not procrastinate. Do not wait until the last minute during tax season. Start gathering your documents and understanding your income now. If you work with a tax professional, schedule a conversation early to ensure they are applying this new deduction. If you prepare your own taxes, take time to read the instructions carefully. Do not leave this money unclaimed because the process seemed overwhelming. Also, be vigilant against scams. No one should charge you money for information about this publicly available deduction. Your tax software will handle the calculations, or your preparer will know how to apply it. Protect yourself from anyone claiming to have a secret method. The bottom line is clear. If you are 65 or older and your income is below the phase-out thresholds, you must claim this deduction. It represents substantial savings specifically designed to help seniors manage the financial realities of retirement. Take full advantage of it while it is available. You have 4 years. Do not let this opportunity pass you by. Your future self will be grateful for every dollar you wisely save.